Hello and welcome to Forex.Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we're going to be discussing Forex options and volatility. Historical volatility. Historical volatility is the calculated or statistical volatility of an asset. It merely measures the price fluctuations of a security over a specific time frame. For example, we can calculate the standard deviation of the Euro-USD pair over the last 20 days to get the 20-day historical volatility. Options traders then use this value to compute the fair price of a given option. If historical volatility is 25%, it means that the asset's likely movement within the next 12 months will be in the range of about 25% from the current price, plus or minus. Implied volatility. Implied volatility represents the volatility of an asset expected by the market over the life of an option. The difference with historical volatility is that the latter is based on the past price changes. In contrast, implied volatility is the volatility implied by the current price action of a given option. Historical volatility looks past, whereas implied volatility reflects the market's expectations for future volatility. When the expected volatility decreases, the option's premium drops, and when it moves up, the option price goes up. Thus, assets with lower levels of implied volatility will hold cheaper option prices. Implied volatility changes as the view of the market participants shift. Option sensitivity to the changes in implied volatility varies with the time to expiration and strike to spot price distance. An option that's nearing expiration will be less sensitive to implied volatility changes than a similar option with a longer time expiration. Also, options with strike prices at the money have the highest sensitivity. In contrast, options deep in the money or out of the money are less sensitive to implied volatility shifts. How to effectively use implied volatility? We can follow the asset's implied volatility and take note when it peaks and when it troughs historically. We can do this to determine when it's relatively high and low. Following this procedure, we can determine when option prices are cheap and when they are expensive. Also, since volatility tends to be a mean reverting and cyclic, traders could forecast the potential move towards an average value. Volatility forecasting by itself is not a standalone strategy, but can help traders decide their optimal option selection. For instance, if the options are expensive and a trader expects this to revert to a lower value soon, he may choose to sell instead of buying overpriced options. Strategies following this idea can be covered calls, naked puts, or credit spreads. Also, during low implied volatility, the purchase of options is the best choice. In that case, long calls or even a long straddle, which is a long put plus a long call, can be profitable. If you enjoyed the video, then please like and subscribe and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.